cream and marshmallow on the beat.
I think somebody's at the door. Hold on, y'all. Somebody's at my door. Of course, as soon as I decide to go live, somebody wants to come to my house. Mr. Shop on the so he's coming right back. What's my gun in the trap? Da 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 da. Okay. Hey, what's going on, Malika? How are you? Yeah, I decided to go on real quick because especially with my event coming up and talking about business and stuff, it's tax season. Let me turn this music off. Hold on. Let me turn it down. I'm just giving time for people to roll through. Shout out to you, Malika. And actually, let me give a shout out to the how do I create? Let me create one of these. Today's sponsor was Kareem Austin. And I'll scroll that across. So Brooklyn. Ah. I'm gonna edit it. Alright. Now let's save this. Alright, Malika. Salute to you. Shout out to everybody in the building. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. And I've returned today to whap and tap on your head with another ADH wealth solution. Before we go in, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, to purchase life insurance directly up to $1 million with an instant decision and no medical exam, or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description. So as we proceed to give you what you need, I actually got inspired to go on today due to a gentleman by the name of Savings Minus Debt. And I did not watch a lot of his live because I was, floating around getting ready for the Super Bowl and all that good stuff. Controversy aside, I know a lot of people don't partake in football. I'm not one of those people. I happen to partake vigorously in football along with my wife. We are avid football watchers. However, what he was talking about was tax time or tax season hunting. And this is generally a time where people will get tax time hunted, if you will. And so generally what happens is during tax season, you get, everybody flying out of the gates, offering, tax prep services and blah, blah, blah. And, you've got Jackson Hewitt and this one, that one, and the third. Now, as you know, I do have my PTIN, which is my Preparer's Tax Identification Number. And the reason I got my PTIN was to get into the tax season hunting game as well. And what do I mean by that? Well, a lot of people during tax season tend to, come out of the woodwork as, overnight accountants and blah, 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 this, that, and the third, right? Which, to be honest, is really unfair to the general public because y'all end up getting, the fluffernutter of what services are truly offered to you when people are just coming out kind of tax time hunting you and just coming to do your taxes, yet they call themselves accountants and this, that, and the third. I know I'm dragging on a little bit. I'm also multitasking. I'm taking care of a little bit of paperwork as we speak. I promised some things to some clients of mine over the past few days that unfortunately I was unable to deliver through no fault of my own. However, I do like to under-promise and over-deliver. What's going on, Kay? Hey, Malika. What's up, Kay? So, yeah, I do like to, under-promise and over-deliver. And unfortunately, I was unable to keep my promise because certain paperwork that I promised to people ended up not getting to me till recently. Which is, generally with my clients, I'll tell them, hey, listen, I'll send something to you within, 1 to 2 days. And usually that's because I have the document on hand. This particular situation, I didn't have documents on hand, so I was unable to get those documents in the speed up with which I was used to. So having to wait 4 days for home office to send me a simple email uh, kind of ticks me off a little bit, but it is what it is. Now that I have the email, I can do the things that I need to do to move forward with my clients so they understand that I'm not twiddling my fingers. And not saying that, that's how they feel. It's just that's the kind of professional I am. I don't like to leave folks, just waiting. I don't like to be left waiting. So, as a stubborn kind of client or a client with high expectations, I have high expectations for my clientele as well in being your profession. That's just kind of what you get when you get what you pay for, and when you pay for a top tier service, you get it. You know what I mean? So that's kind of the way I operate. But so with this being tax season, what I want to do is often, people look at things like insurance. And I'm going to start speaking again specifically toward insurance, even though I do other financial products. I want to start speaking specifically towards insurance. And people look at insurance as just, a big check when something happens. But it's bigger than that, and it's more than that. It's actually an asset, and it can help you to get the things you want. The other thing that made me want to go live was I see all too often financial gurus and financial professionals, and even those who have come to be financially free or financially quote unquote literate, are making a huge mistake. And what is that mistake? Well, I'll tell you. That mistake, my friends, is a mistake of hoarding. Well, what do I mean by that? Well, people are, save your money, save your money, save your money, save. Put it away, invest. And nobody's telling you to spend. Now, you're going to be surprised that a lot of financial professionals will tell you to spend. It stimulates the economy, and it keeps things going. It keeps you able to make money, and us able to make money, and everybody else able to make money, and it keeps the economy going. If we all just stockpile our money in the stock market, the economy would crumble. So it's also to promote spending, right? I'm one of the few financial professionals who talks about spending. Most of the time you'll hear people just say, don't waste your money on Jordans, right? Well, I'm going to tell you, no, go ahead, spend money on Jordans. But instead of buying 4 pairs of Jordans a month, buy 3 pairs of Jordans. And the money you would save on that 4th pair of Jordans, you put in a financial vehicle to make sure that you could buy 3 pairs of Jordans and stun on motherfuckers for the rest of your life. Because let's be honest, what are we making money for other than to spend it? See, that's the point of generational wealth. The point of generational wealth is not so that, I'm this big rich motherfucker with a bunch of money. It's so that you and your family can have time, freedom, and the ability to do what and when you want. So the purpose of money is a tool. It's a utility. And it's supposed to provide you with those things. So today, what I want to take a look at is just a couple of tools that financial professionals should be using with you when it comes to your finances. So give me a second here. All right. So as you guys see, this is my home screen. It's small here. Let me increase it really quickly. So as you can see, this is my back office for one of the companies that I represent. Give me a second there. I done made the screen too damn big. Now I can't navigate it. All right. At any rate, so you see my name up here, Alonzo. At any rate, here's some of the calculators that we have. Obviously, there's product-specific calculators, and we have saving and investing calculators. But seeing as it's tax season, we're going to look at some of the taxes and debt calculators that I use here, right? So as a financial professional, this is part of what booking a consult with me consists of, right? So it's not just one meeting situation. There are those situations, but our intent is to really have an ongoing relationship. Okay. Yes, salute She, what's going on? And make sure, ladies and gentlemen, that y'all hit that like as you come in. Like Malika said, hit that like button as you come in. Right? So as we're looking here, we're looking at taxes and debt calculators. So as your financial professional, it's supposed to be, an ongoing relationship. For example, we're coming up almost on having been a year in having done business together. So expect in the next month or two, I'll start reaching out to you because we'll need to do a review. Now, it's not necessary for you to do a review once every year. That's just, again, I'm a salesperson, so it is an opportunity for me to reach out for other sales opportunities, obviously, but it's also a good thing because things have changed, right? Gas is a whole lot more expensive. Maybe your budget has changed. I know you said things to me like you're looking to get that $1 million mark, right? And, when we first sat down, I could have been like a screwball agent and been like, yeah, here, let me get you there. Boom, here's an extra. But I told you honestly, from the assessment, what we're looking at, me and my team looked at it, you really don't, I'd love to get the commission, but at that point, you really didn't need any more. And we made the decision to put the policies on your sons. But certain circumstances may have changed. It's been about a year. You've been doing some things in these streets, in the YouTube streets and in the streets. So it's time to do a review. Sheep stay sleep. Salute, what's going on? Shout out to the A Game Nation in the building. Make sure you go pick up your A Game. I ain't even affiliated, but I don't even care because it's a black product. You know what I'm saying? And that's how we need to get down, right? He's here to show me his support, so I'm going to support. Masculine mercenaries. But let's take a look. So actually, I'm going to ask for some audience participation here. I'm going to look at 3 calculators, and I want you guys we're going to look at let's see. So some of the calculators I have here in my taxes and debt tools are tax calculators, debt management calculators, home mortgage calculators, right? So let's take a look at some of the calculators we can look at. Let's see. We've got, will my investment interest be deductible? How much self-employment tax will I pay? Or compare tax-deferred and tax-free investment growth. So put a 3 in the chat if you want me to compare taxable, tax-deferred, and tax-free investment growth. Put a 2 in the chat if you want to learn about how much self-employment tax you'll pay. And put a 1 in the chat if you guys want to know about, will my investment interest be deductible? I'll wait a few minutes, let you guys put what you guys think is best in the chat, and then we'll go from there. In fact, I should play some waiting music while I'm at it. Actually, I need to go get me some water because that's one of the things, right? If we look at something and, I'm not stealing, I'm paying homage and I'm paying respect, right? So right now we have Malika with a 1 and Sheep Stay Sleep TV with a 3. So we need a tiebreaker unless somebody else puts a 2 in the chat. Right? So I want to give shout out to Sheep Stay Sleep TV and the Crimson Cure because they talk about the lost value system. And right, part of it is, the financial aspect is one of those external values, right? The external 5. But it's also related to an internal 5 in the fact that this is knowledge that's passed along from generation to generation. You see, we didn't learn how to have fucked up credit just one day, especially if we come from the areas that we come from or the lifestyles that we may have come from in the African American diaspora, right? A lot of us came from, single parent households or households where the majority of us didn't have, great financial acumen. Even with financial literacy, if you don't have financial acumen, it doesn't really make a difference. So give me one quick second. I'm going to go grab some water, and then we're going to come back and learn. But I wanted to make that statement because part of this learning can be folded in to that, that initial 5, right? Those inner things that you can't see, right? In the lost value system. And it's upside down because we're all chasing that bag. Everybody's looking about the money, the money, the money. But you can't just get money and neglect everything else. Because then what happens is the house collapses, it crumbles, because the next generation doesn't know what to do with the money. For example, Sheed is not just compiling money and calling it a day. He's doing this and he's going, okay, let me teach my sons about ABC, XYZ. Let me teach my sons how, money works. And that's an important lesson. That is transferring, those life values, those lost values, right? Because they're not lost now, because you're getting that love and you're getting that, you're getting that security, you're getting that order, from your father, right? Or you're getting that discipline and discernment from your dad, right? Because he's giving you discipline. He's also giving you discernment, right? And he's teaching you about, your attitude, right? Because with kids, you might get a little with your mother, but your father, as soon as and that's a male influence. Shoot, it happens with me with my nephews or my godsons. My nephews, right? They'll come over. They call me Uncle Snoop. They love come as soon as they come. So they're what, 8 and 9 years old now. They come see me. First thing they do, come run and punch Uncle Snoop in the stomach, and then we fighting. Right? Now, when it gets to be too much, all right, boys, enough is enough. They'll get a little fight. Hey. Oh, and then they realize, okay, he's speaking with authority, right? So that, ironically enough, and like I said, this was all about getting to the bag, but we have to realize, and this is something that in these spaces of Black YouTube, we have to do more of. We can always drag people for what we think is wrong. Oh, this dude said that, that's wrong. And this dude did that, that's wrong. And, I don't rock with that. What we should start doing is being heroes and focusing on the solution. Part of the solution is, instead of pointing out the negative, this is why you have things like people talking about black on black crime. Because she says a man's voice will stop any child. That bass just does something. Right? I know it is. Hey now, child, you better But so when we're looking at these things, we just got to understand where they come from. I'm going to take a brief intermission to go grab me some water. I'll be right back. And again, so far we have Malika with a 1, and Sheep Stay Sleep with a 3. So 1 is, will my investment interest be deductible? And the 3 is compare taxable, tax deferred, and tax-free investment growth. Okay? So again, we're looking at 1 or 3. And then 2 is how much self-employment tax will I pay? But right now we're basically voting between 1, how much will my you know what? I may do both. We shall see. Bear with me. I'll be right back. Go grab my water. Salute the perfect timing. All right, I'm back. So, all right, we don't have another vote, so you know what? Since both of you voted, both of you gonna get what you asked for. So we're gonna start with, will my investment interest be deductible? Oh, I gotta do it like this. Hold on. All right. So this is a calculator. Let me see how large this is for y'all. All right, yeah, that's good. All right. So, will my investment interest be deductible? Interest paid on debts incurred in order to invest, such as margin accounts, is generally deductible to the extent that it offsets investment income, such as interest, dividends, and short-term capital gains. Interest payments in excess of investment income can be carried forward in hopes of offsetting future investment income. This calculator can help you better manage the use of debt as an investment tool and more accurately time your income and interest payments to take best advantage of current deductibility laws and limitations. Oh, also Malika, I've got some good news for you. So I'll get in touch with you shortly after my live today. So we're going to start with the federal income tax information. Marginal tax bracket, lower income people are at 22%. Once you're over 50 grand, you're at 30. So, yeah. So we'll put you at 22. We're talking head of household, so you're between 54 and 86,000. So let's say dividend income, let's say this is actually liquidatable. So this is money that you're getting from your dividends. Now, you're not going to get a whole heap of money from your dividends. Let's say you're at the top of that 22% tax bracket and you're making basically 85K. So you have a good amount of investments in there over a number of years. Let's say in dividends, you got $400. Interest income. So this is income off of interest of, like high yield savings accounts. So the average, right, high yield savings account yields you 0.5% interest. What the heck? Oh, okay, so let's see if, right, let's say we've got 20,000 in a high yield account, so it's going to be times 0.005. So you're going to gain about $100 of interest. Your short-term capital gains. So this could be things that inflated quickly. Let's say you've got some Bitcoin and it's accreted fast. And you've got, you got a few grand in Bitcoin. So we'll say you've got $3,500 worth of short-term capital gains. That's Bitcoin and everything. Now, margin account. We're going to say you have no margin account. You're not borrowing to invest in stocks. You're just doing straight cash. And other investment interests. Let's say you've got some money in Acorn and Stash and what are the other? Robinhood. And altogether, over the course of the year with all your investments, now you've got some tens of thousands to be getting this much interest, just so you know. But let's say you got $500 of investment interest there. Submit. So the interest you earn, and we're going to check the results here. Based on your input, you'd be able to deduct $500 for a total tax savings of $110. So the summary is the interest you earned over the course of the year was a total of $4,000. That's a huge amount of interest to have earned, but it's plausible. Right? So I'm trying to go with, fairly realistic numbers. She says you always come with good news, elbow cloth. Yes, I try to come with good news, Malika. So the interest that you paid was $500. So the deductible interest is $500. With you being in a 22% tax bracket, your federal tax savings for the current year would be $110. So will my investment interest be deductible? Your interest that you earn is $4,000. The federal tax savings is $100, and your deductible interest is $500. So you can deduct, again, $500. All right? So that's a quick calculation. Again, these are arbitrary numbers. Things obviously change because a lot of these numbers, like I said, these are, people have at least tens of thousands invested in these situations. Okay? So I'm going to stop this one. And now that we've got that out the way, we were going to look at compare tax. Okay, here we go. So here we can compare taxable, tax deferred, and tax-free investment growth. Now, again, this is not investment advice. This is not financial advice. This is just hypothetical situations. If you would like to have a consultation of your own, my information is in the description. You can click the link and schedule a consult. We can get to the very specifics of your situation. So investment vehicles are taxed differently. This investment growth calculator is intended to help compare a fully taxable investment to two tax-advantaged situations. In one situation, an investment account is not taxed until the money is withdrawn. In the second scenario, the money is in an investment that is not subject to federal or state tax. Okay, hold on, y'all. I'm about to share my screen. Are y'all seeing this? Hold on, wait. My mouse froze up on me. So bear with me real quick. I should probably buy a new laptop, but such is life. Okay, here we go. All right. So if you'll see here, we'll start with our savings, right? So let's say we're going to use a round figure. Let's say 20,000. And then your annual contribution. So how much are you saving per year to that 20,000? Let's say you're saving 5,000 a year. Okay? And your number of years to invest, we'll keep it at 20. We'll say this is a person who's in their mid-40s. You can be 45 and start investing for 20 years. It's really not uncommon. Now, let's say your before tax return on a fully taxable investment is going to be 8%. So the historic rates of return from 1926 to 1929, inflation has been 2.9%, or on average 3%. It's closer to 7% now. Your U.S. Treasury bills have been returning at 3.3%, and long-term GO or government obligation bonds have been 5.5%, which is generally what life insurance has been resting upon for about this historical amount of time, which is why they've been giving you a guaranteed rate of a 4% return. That's how cash value life insurance works, is it works on the rate of government bonds. And if you'll see here from 1926 to 2019, almost 100 years, bonds have been at a 5.5% rate of return historically, which is growing over the rate of inflation, right? Almost by 2.5%. So we've been locking clientele into 4% rates of return for about that rate of time. However, this is why you've heard about that thing called IRC 7702, Internal Revenue Code 7702, and now it changes the rate of return, and with which insurance companies are now changing this rate. So now they used to promise 4%, which was just above inflation, but now inflation has almost doubled, and now insurance is only guaranteeing 3%, and they've increased premiums. But again, these are investment assumptions. So we're assuming that your before tax return on a tax deferred investment is also 8%. Now, these are some good returns, getting 8% on your returns on your investments. And again, these are before tax returns and before any money management fees. Okay, because don't forget, you're going to be paying fees to your financial advisor, right? So it's not just, hey, I bought this investment, it's done. No, you remember, I told you there's things called 2 and 20 fees, which is 2% of your net worth annually, and which is why you have to come with a minimum to invest, and why they look for accredited investors, because we want to know that you can afford to pay us at least $10,000 a year for selling you a stock 10 years ago, right? So we know that over the course of 10 years, if you buy one stock from us, over the course of 10 years, that's about $100,000 that we stand to make off you, outside of any investment commissions, right? So that's why we look for accredited investors. But at any rate, so we're assuming that you're getting 8% return on your investment. Okay, so when people are telling you these astronomical things, like your Primerica guy says, yeah, put your thing in the life insurance and invest the rest, and we're going to get you a 12% return. Historically, returns haven't been like that, and that's why we're going on a liberal side here, offering 8%, right? Because even companies that give the highest dividends are only giving 6%. So something at 8% is, like I said, astronomical. Right? But so now we're assuming that your return on tax-free investment is 5%. So 5% is more along the lines of where things are getting, right? If you're looking at like 10%, you're looking at things like the S&P 500, right? The S&P 500 historically, for about the past 40 years, has been performing every year at about 10.3% year over year, or year to year. Right? Whereas in 2020 with the pandemic, it performed at 13.3%, which was the highest historically ever, which, Trump was and trumpeting his trumpets about that. That's neither here nor there. But so now we're going to look at your marginal tax bracket. Okay, and we're going to assume that that's 25%. Okay, and the 2021 federal taxable income brackets and rates, and this is for returns due this year in April of 2022, right? So we said that you're right there at the 85K single, right? So you are at that 22%, right? So we're going to say marginally you're at the 25%. So let's change that to 22%, because this is a single person, right? So based on the assumptions you provided, you could expect to accumulate $255,855 in a fully taxable account, $277,583 in a tax-deferred investment, adjusted for taxes, or $218,396 in a fully tax-free investment vehicle. So let's take a look at each rundown. The current investment vehicle, right, in a fully taxable account is $20K, is what we're starting with across the board, as you see here, right? And our annual contribution is $5,000 a year, right, for 20 years, right? So if your before tax return is 8% on the fully taxable and the tax deferred, right, then your tax-free is at a lower rate. Sorry, I'm rolling up. And so, now again, we're all at the same tax break, But again, here, because it's fully taxable, your actual return here is going to be 6.2% after taxes, right? Now they're saying in the tax deferred, it's an 8% return. But remember, when you get that money, you have to pay taxes on it, right? Now, when you get the tax-free vehicle, your account value is the least, right, at $218K, but it's pure liquid, right? Your tax-deferred account, while it's $322K on paper, your spending power after that tax is $277K, right? So basically, the tax-deferred is likely your best option with those rates of return. Again, that's at an 8%. This one is most likely accurate. These two are a little high. These two are closer to 5% as well, especially in today's market. Rates are low. Whereas here, right, your future account value, so your after-tax return is basically liquid to liquid, and that's fully taxable. So that will be paying taxes up front, right? Now, again, at the end of the day, tax deferred, you end up with more money. Now, your account grows a little harder because you're not being taxed on that, right? Until you withdraw. Now, if you'll notice, it's the lump sum shown after taxes is based on the marginal tax rate that you selected. This lump sum after tax figure does not take into account the possible change in tax bracket that might occur due to a lump sum distribution of the taxable amount, nor does it take into effect any applicable tax penalties. For example, if you take this out before 59.5, there's an additional 10% tax penalty. Bear with me, y'all. Hold on. Babe, you on the phone? That was the TV? I don't know. I guess I heard the TV. I'm sorry. I thought my wife was calling me, then I thought she was on the phone, then I guess it was just the TV I heard. All right. Getting back to it. Let's see here. Check these comments out. Malika said hi, babe. She said hi. Yeah. All right. So this is your investment growth calculator. So that's on a little bit on taxes and debt. Let me share a little bit more with y'all briefly, just because I can. And we will look at some more of the possible calculators. So now that we've looked at the taxes, let's take a look at a little bit of debt management. So while we're here, let's have some audience participation. So I'm sure savings minus debt would encourage you guys to look at this, as would my friend Lash's Journey. They're both acolytes of, or not acolytes, but students of Dave Ramsey's Getting Out of Debt School. And they've successfully graduated. So kudos to them for that. At least for that aspect of things. So let's take a look here. We have a few calculators here. Let's see which ones are interesting. So I have, what will my loan payments be? How long until my loan is paid off? How long will it take to pay off my credit card? Should I pay off debts or invest? What is the impact of making extra payments on my debt, which is better up front? Okay, so Put a 1 in the chat if you'd like to hear about should I pay off debts or invest. Put a 2 in the chat if you want to see about which is better, cash up front or payments over time. So I'm gonna, Snuggles, what's up? Snuggles is in the building. So yes, ladies and gentlemen, put a 1 in the chat if you want to see should I pay off. You know what? Screw it. Let's do them both. Okay, so we're gonna start with should I pay off my debts or invest? It's tax time, right? So, should I pay off my debt or invest? When you receive some extra money, it may be difficult to determine whether you should invest the funds or use them to pay towards liabilities. Financial theory recommends that if your after-tax return on investments is greater than your after-tax cost of debt, then you should invest. Use this calculator to help analyze your situation. So you see here it's got the rates and assumptions. So we're assuming that your interest rate on the debt is only 8%, which we know isn't likely. Let's give a realer interest rate. Let's give 18%. Is the interest rate deductible? Usually no. Your before tax rate return on investment. Let's go high with that. Let's go 10%. Is the interest taxable? Yes. Your marginal tax bracket. Let's go 25%. 25%. Okay. Submit. So after taxes, your debt costs you 18%, while your after-tax return on investments is 7.5% based on your current input. It appears that you would be better off paying down debt as rapidly as possible. So again, this is what people like savings minus debt are talking about when he says you have, so, because this is one of the things that I encounter often. People definitely want to talk about investing. And by no means am I saying or discouraging anyone from investing. But at certain points, there's levels to it, kind of like Meek Mills, right? In fact, that's going on right now, just because of that. Aha. So there's levels to it, right? So what I mean when I say there's levels to it is this. When you're investing, you should probably start off with a robo-advisor. Something like Acorn, Robinhood, Stash, apps like that. That's why, even though I speak negatively of things like Bitcoin and Coinbase and all that other stuff, it's a positive, especially for Black folks, to at least learn things like these charts, etc., right? But there's levels to it, right? Because if you're in a certain position, you should be using that money as expendable income only. You shouldn't be having a budget for investing. You should be using that budget for paying off debt, so that while you're investing, you can have a cushion. What do I mean by cushion? You need about $5,000 to $10,000 that you can just sit on in case something happens, right? Other than that, you don't need too much more. That's immediately liquid, and then you can actually have other investment vehicles that are that liquid. Lord, there's levels to this, levels to this, levels to this, levels to this. Okay, let me see if I want to see what I look like right now. Let me turn on my camera. Okay, that's what I look like in the camera. Hold on, let me see something. is what it is. At any rate, wow, I've been going for almost an hour and I'm nowhere near done. Well, thank y'all for being here. You could have been anywhere else and you decided to be here. But again, there's levels to it. And what do I mean by levels? Even though you're going to get information like this, and the reason I went at 18% is because that's a realistic rate. Unless, your only debt is something like, for example, let's say your only debt is a mortgage. So your interest rate is something like 4%, right? And then your interest wouldn't be taxable because you're getting a 10%. Well, you're not going to get that high. Let's say you're getting 4% rate of return on your investment before tax, but it's not taxable. So now, after taxes, your debt costs you 4%, while your after-tax return on investment is 4%. Based on your current input, it appears that you would be indifferent as to whether to pay down debt or to invest. So a person like this is a person who may only have a certain like you might only have a mortgage. And in that situation, you might be level with your debt. And if you're level with your debt, then you have an option. You can take the path of paying off the debt and investing minimally. If you invest minimally, right now your investment is a fixed investment because it's an after-tax or a tax-free investment. Or even if it's tax-deferred, right? If it's tax-deferred, you might be getting, 7%. Let's see what happens when you get 7% on the tax-deferred. So now, based on your cost, right, with a 4% debt, and your return on investments being 7%, it appears you'd be better off investing any surplus funds while paying your minimum debt payment, right? Because now your cost of investment is beating your cost of debt is being outpaced by your rate of return, right? So you'll be able to pay off that debt, invest, get your dividend, pay off that debt, invest, get your dividend, and then this will just grow larger. So now, let's take a look at the next one. So what's better, cash up front or payments over time? Now again, this is not financial advice. This is not investment advice. This is just a personal opinion and hypothetical scenarios being shown with real life calculators in real time. Okay? So take this with a grain of salt, but know that the possibility is there for you. If you'd like to start the process, couple things. Make sure you hit that like, drop a comment, subscribe, hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, to purchase life insurance directly up to $1 million with an instant decision and no medical exam, or to schedule that one-on-one appointment with a licensed financial professional, the link is in the description. Let's see here. So that we are looking at lump sum. Okay, let me share this screen for y'all. Love. Because it's levels. Sorry, I just had to get my feels right quick. I should play the song because that's my ish. And, I'm unorthodox like that, right? So hold on, let me see if I can play my song. Is this the clean version, hopefully? Let's see. Brad. Whoa. Is this a Manosphere shout out? Oh Lord. Let me see. Cause it's level to this. Huh? Cause it's level to the what? Hey, listen, I can be a consummate professional, but I'm going to bump trap music on my way to our appointment, y'all. It gets me in the mode to help you the most. Level to kid. Cause it's level to and I be putting the devil in this bitch and I'm breaking back like a gold medal to this bitch loud. Yeah. Kurt Cobain. Boom. I don't know. So what? Shit. 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 Alright, anyway, so which is better, ladies and gentlemen, cash up front or payments over time? I apologize for the little trap music moment, but you know, that's the era I grew up in, that's what I came from, so it is what it is, and it ain't what it ain't. Look, see? Malika, no, there's levels. So, use this calculator to help determine whether you are better off receiving a lump sum payment and investing it yourself or receiving equal payments over time from a third party. So this would be a scenario where you have, like, let's say a structured settlement or a payout that comes to you annually. And you want to do something like buy a house. And you need X amount of dollars for a down payment. Now, you can show on paper in order to qualify for the mortgage that you have this annual payment that comes to you, right? Let's say you're receiving a death benefit. Let's say your grandfather died and he left you $1 million. And he has it structured so you'll be getting paid X amount of dollars a month every month for, until the $1 million is gone. So you'll get $50,000 a year for 20 years. Right? So that's $6,000 a month for 20 years. Right? So with $6,000 a month, that's cool that you can show that income stream coming in so you're able to support that and show, documents that you have that. However, when it comes time for, putting a down payment on a home, you may need a lump sum of $60,000. Well, that provides an issue because you only receive $50,000 initially. So you can do things like collateralize, etc., but let's just see in this situation, if hypothetically you're able to borrow that $60,000 or, if you have that $60,000, is it better for you to pay it up front or is it better to borrow that money over time? So you're going to use this calculator. So let's say it's $60K and your potential return on investment with a similar risk is 8% return. Okay, and again, these are those historic rates. So we're going to say that it compounds annually or monthly. We're going to say annually first. And what is going to be the annual pay in? So we're going to go $5,000 a month. $5,000 a year, sorry. Your annual increase percentage in payment. We're going to do it like rent in the city. So we're going to do 3%. I'm going to do numbers of payment. Let's do 72 months. And let's do 60 months. And what is that, 5 years? So you'd be better off receiving payments as the value of today of your discounted payments today is $101,716 compared to $60,000 up front. So basically what that means is you should receive, if you receive the annuity and just stave it out over time instead of taking the lump sum, you'll receive a total of $101,000 versus $60K. So this would be a situation where maybe you'd have to find that $60K somewhere else instead of taking it from J.G. Wentworth, right? So this is why you're receiving annuity payments, we'll say, or you're receiving, payments from a lawsuit. And you won, like I said, $1 million or $50,000 a year for 20 years or $5,000 a month for the next 20 years. But you needed $60K right now. It'd be better, instead of calling J.G. Wentworth and getting that $60K, taking the $101K, right? Now, if you get it in one payment, obviously, you'd be better off taking the lump sum today, right? Because if you're getting it in one payment, that's a payment of $5,000, payment over time, versus taking the cash up front, which would be $60K. But that would be one payment. Let's see, if you break it down to, let's do over the course of 1 year, lump sum versus 12 payments. So if you're going to take it in a lump sum, it's better to take it in a lump sum of $60K instead of the payments over time, right? So your strategy here will be a tax system, because you'd still have to pay taxes on that lump sum of $60K, right? And that's going to put your tax bracket elsewhere. Where would your tax bracket go? So right now, we're assuming that you're in a 22% nominal tax rate. But if you're at that 85K, or even if you're under that, let's say if you're at 40K and you get another 60K, that pushes you to another tax bracket, right? So now you're going to be at more like a 25% tax on your income. Excuse me. Whereas over time, you're going to be taxed less. So is the dollar more? Because you have to realize they're going to take 25% of this. So it's 25% of 60K, right? So that's 60, right? Times what, 0.25? So that's 15K. So, all right, so that actually still be about even, right? Because 60K minus 15, right? Leave you at 45. So you're about even in that scenario. So yeah, in that situation, it's probably better to take the lump sum. You'll have the whole 45K available to you. Check these comments really quick. Says it's available for people to see. When people win the lottery, they do not know which one to get. It is available to see, but you have to know when to see someone. For example, especially in our demographic, I'll talk to our people and I'll say, hey, I'm a financial advisor, da 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 da. Okay, when I get some money, I'll see you. And then they go to, Mohegan Sun, which is a casino out here in Connecticut. And, they'll hit, that's where the Connecticut Sun play, the WNBA team. And, they will hit the lottery big. And it don't have to be, huge. They'll hit for $5,000, $10,000. And, yeah, the minimum to talk to a financial advisor really is $10,000 plus whatever commissions. But it's worth it to have that conversation at that point, because there's levels, right? And now you're at a different level. Once you get to that level, you want to seek out some help, right? So yes, these things are all available, but you have to seek out the help, because there's no alarm that to someone to say, hey, boom, hey, so and so just won, $200,000. Let me go check on them, right? Unless you're on the news, and then when you're on the news as a winner, how many people do you think? You think everybody from Goldman Sachs and Morgan Stanley and Charles Schwab and Bank of America and Chase Bank and Wells Fargo's HSBC private client ain't calling you? Yeah, they are. Hey, Mrs. Jones, you just won the lottery. I know you just won it. Hey, let me tell you about this great investment opportunity out here in the Florida Keys. Hey, have you ever thought about Bitcoin? Trust me, they're getting a million bazillion calls. But you're absolutely right. Stuff like this, unfortunately, falls on deaf ears because they're getting so many of those calls. Everybody calling you that. Okay, so we're going to stop this one, and we're going to take a look at some other calculators. So let's see. Chrome. So let's take a look at home mortgage debt calculator. So how much home can I afford? Should I refinance my mortgage? Then we have a comprehensive mortgage calculator. We can compare mortgage terms. Should I pay discount points for a lower interest rate? That's actually a great thing. If you didn't know, there's a couple of ways you can also pay down your mortgage. Because it is a 30-year obligation, and generally there's no way around buying a house without financing it, right? Nobody really, even wealthy people, right? Even if they got $1 million lying around, they're not going to put all of their liquidity into one asset that may depreciate. Make sense? All right. So, give me a second there. I'm probably going to have to take a quick hiatus and get some more water. Stay thirsty, my friends. Okay? Then we have comparing mortgage terms, but you can actually pay off points on your mortgage. So you can pay off parts of your debt, right? And what do I mean by that? You can actually pay a certain amount. And while you're paying that amount, you can actually pay a percentage point off of your percentage rate. So what does that mean? That means that you can, if you're getting, let's say you're at a 3% interest rate for your mortgage, you can actually pay, let's say, $15,000 and change that 3% to 2%. Okay, and that's how you can actually pay off points on your mortgage, and you can pay it down to 1%, so that you're only paying a 1% interest rate on your mortgage, and more is going towards your principal. That's another way to combat having a long-standing mortgage. Give me 1 second. All right, I'm back. Yes, really, Malika, you can pay points off on your mortgage. So that's actually here. Should I pay discount points for a lower interest rate? Should I rent or buy a home? Should I convert to a biweekly payment schedule? We can compare a no cost versus a traditional mortgage. We can say the tax savings that's generated by your mortgage. Now, this is actually changed because of some of the tax code changes that Trump has put in, where there's a mortgage. I think the interest max deductible is $10K. So that's why as hot as the real estate market is, for a lot of people it isn't, because they can only deduct $10,000 on their mortgage interest a year. And especially in places like New York, where you automatically, when you purchase a property $1 million or more, you have to pay mansion taxes, which is 1%. So that's already $10,000 you have to pay on that mortgage, which is kind of effed up because it's like, well, damn. And then, which is better, fixed or an ARM, adjustable rate mortgage? So let's take a look at, since that piqued your interest, Malika, we're going to take a look at paying off points for a lower interest rate. Yeah, mansion tax is generally, that's something that is, I don't know if it's in every state, to be honest. I know it's in New York. But again, these are when you're buying a property $1 million or more. So I'm not, in fact, now that you mention it, I'm going to Google it. Google mansion tax. So, how does mansion tax work? Okay, New York City. Mansion tax is calculated for $2 for every $500. An additional tax of 1% of the sales tax applies to the residents where consideration is $1 million or more. That's the New York City mansion tax. I think it may only be in New York. No, there's apparently mansion tax in Connecticut. Okay, let's go. What is mansion tax? Or is it only in New York? Yeah, it's a New York thing. Oh, no, there's some New Jersey. Here we go. A mansion tax is a common name for an annual property tax on high-value homes. Although the term itself is widely regarded as a misnomer, the tax was only a proposal in the United Kingdom, but provided very controversial and widespread media coverage. It did not go ahead. Okay, I don't know what they mean about that, but here we go. That's Wikipedia. Well, at any rate, that's neither here nor there. But yes, millionaire tax is something that, again, is common in New York. I said I'm not in that millionaire tax bracket yet. I'm glad that you said yet. Listen, Friday will be some great information for you guys in order to be in that bracket. Okay, so get ready for that, y'all. Again, that's the Brunch and Wealth. Please register in advance. And, we're likely going to have some kind of a giveaway for you. So, should I pay discount points for a lower interest rate? Now, in some cases, it may be beneficial for you to buy down the interest rate by paying extra money upfront in the form of discount points. Use this calculator to help determine if this makes sense for you. So, let's say your home averages $300K. So let's just do that. Wow. 30-year loan. All right. So we're going to just do these two alternatives right here in your mortgage alternatives. So we're going to say discount points of 0% on the 5, and we're going to have actually the exact same loan interest rate. So we can see the difference. Now, those are both high loan interest rates, but all right, so it doesn't make sense at that rate to pay extra discount points, as there's no discount cost associated with the discount points. Okay, so that's if they're at the same rate. Now, again, we're going to do this one at 5.25 again, see what the difference is. So it appears it would take 64 months or 5.3 years to break even. In other words, if you plan on keeping the loan for more than 5.5 years and you have the cash available, then you should consider buying down the rate with extra discount points. Okay. And then, so you'd save $47 a month. Again, when you're looking at mortgages, Like 20 grand is only $100 on your payment. But 47 or $50 a month is $600 a year. Ironically enough, that could be a life insurance policy. That could be building you more cash, right? So you're looking at your monthly payment, which is going to be $1,703 versus the loan 2 scenario. It's going to be $1,657. Your cost of your discount points again is going to be 0 here. It's going to be $3,000 here. So you're paying an extra $3 grand up front. Your discount or your difference, your points between the two loans, is going to be $3,000. The divided by the monthly payment savings is $47 a month. That equals 64 months or 5 years for it to make sense to have paid that extra money up front. Or 5 years that you kind of cut off your loan, in essence. And 5 years that you're saving an extra $600. So let's increase that to, let's say you buy down 2%. Now let's do something hefty. Let's do 3%. Right? So it appears that it would take 192 months or 16 years in order to break even. So if you plan to keep in the loan for more than 16 years and you have the cash available, you should combine buying down the rate. So the points stay the same. You're going to pay $9,000 up front. Still going to save the $47. That's with the same interest rate. You ready? I know you're ready for Friday. Okay. So let's see what other calculators we have here. What's better, a fixed or an arm? We can compare rates. Actually, am I sharing the screen? I'm not. Hold on. Bear with me, y'all. We're building this ship as we fly. All right. So we can look at saving or investing calculators. How long have I been going? Wow, I've been going almost an hour and 15. Thank y'all for being here again. Make sure y'all hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, to purchase life insurance directly, or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description. And let's get going. So we've got savings calculators, we've got qualified plan calculators, and we've got investing calculators. We've also got college planning calculators. Now I've got some folks out there with kids. So I may talk, let's see. So in college planning calculators, let's see what we've got here. She says, I'm trying to pay this mortgage down to save some money. Well, Malika, we got time to have more conversations. So, like I said, when I'm done, we're going to talk again. So it says, should I, in college planning. So you've got a college planning calculator here that says, should I live at home or stay on campus? Or should I stay off campus? So this is for someone who is college age, right? Trying to go to college. And you're looking at a number of different calculations here for them to go to college. Now, there's also, you can look at, what does this say? What are the payments on a plus loan, right? What else do we have here? We have, what is the value of a college education, right? So, ladies and gentlemen, I'm going to keep reading over these, and you tell me which ones you guys want to see. I'll ask for a number so that we can kind of get it done. So, for starters, we have 1, which is how much should I be saving for college? 2, will I be able to pay back my student loans? 3, what are the advantages of the Coverdell ESA, Education Savings Account. Remember, I tell you guys all the time, and you guys always hear about a Section 529 college savings plan, but I'm one of the few financial professionals who I ever hear mention the Coverdell. The Coverdell is another education savings plan. So 3, if you want to learn what are the advantages of a Coverdell ESA, or Education Savings Account? What are the advantages of a Section 529 college savings plan? Again, what is the value of a college education, right? So that's 5. 6, what are the payments on a PLUS loan? Or 7, should I live at home, on campus, or off campus? She said most parents want their behinds out of that house. Now that, you ain't never lied, Malika. The parents be like, get them on out. So, actually, you know what? Let's look at number 3. Okay. So, what are the advantages of a Coverdell? All right. What are the advantages of a Coverdell ESA calculator? All right, ladies and gentlemen. So we have the information right up on the screen, and read along with me. What are the advantages of a Coverdell ESA? Tax deferral can have a dramatic effect on the growth of an investment. With the new Coverdell ESA, formerly known as the Education IRA, your contributions can grow tax-deferred and distributed income tax-free as long as distributions are used for qualified education expenses. These costs can include school uniforms, computers, and transportation for elementary or secondary school, public, private, or religious. An annual limit of $2,000 per year for any individual under age 18 applies. Once the beneficiary reaches age 18, they can take control of the account, but the funds must be used by the time the beneficiary turns 30 years of age or transferred to a younger sibling. The ability to contribute to a Coverdell ESA is phased out for single filers with a modified adjusted gross income between $95,000 and $110,000, and for joint filers with a modified adjusted gross income between $190,000 and $220,000. The annual contribution deadline is April 15th of the following year. So this is something actually that is really easy to max out. And this is something that if, say, you don't want to, if it feels morbid to put towards a kid's life insurance, which I would rather tell you to put $2,000 a year on a life insurance policy for a kid, because you could actually pay that up front in a 10-year policy if they're 2 years old at $200 a year, which would be at a 10-year policy for a whole life, and pay $2,000 up front, and it'll build cash value. Now, if you save $2,000 a year, because you're going to max it out, and it's easy to get $2,000, right? It's tax time. So this is a season where you're going to get $2,000. I know people, you get $2,000 just for having the kid. People be getting 6 and 10 and 12 and 14 grand for having a kid, and then blow it on the couch at Raymore and Flanagan. We're going to assume that your before tax rate and return savings is 8%. Okay, and again, these are the historical rates. And again, your marginal tax bracket. And again, these are the current rates. So again, we're going to assume that let's say it's a household. And we're going to assume that in this household, so because it's a married filing jointly, we're going to say, between 81, so 85 grand. Even if they're at 100 grand combined, they're still at a 22% tax bracket. So it appears that by saving for a Coverdell ESA, you would accumulate $80,893 versus $67,181 in a taxable savings account. So if you put the money away in the bank every month for your child, and that's a little over $100 a month. It's like $120 a month that you're putting away for your child. Okay? You're going to save up in that Coverdale. Okay, and let's assume the baby is age 0. So you're going to start from that Coverdale. So you start off, you got 2160. At the end, again, you got 80,000, basically 81 grand. If you were to put that in yourself, again, in a taxable account, first year you got 2125, and when it distributes, it's 67,000 versus this, which is tax deferred, it's 81 grand, right? So, it has a dramatic effect on that growth of your investment. So that's some of the advantages of a Coverdale and what a Coverdale is. Okay, so that's basically, again, an education IRA. So if one child does not use all the money, they can transfer it to another sibling. They have to, yes. So you can transfer it. Obviously, if there's no sibling, you can't transfer it to a sibling. So it would have to be another relative, right? But it have, like if you have brothers and sisters and they have nieces and nephews, you can even do this for nieces and nephews, right? But again, even if you're looking to do these things for nieces and nephews, you can do that for example, for my godson, when he was 15 days old, I bought him a life insurance policy, right? So that life insurance policy is a $30,000 cash value policy, right? So when he's, a certain age, he'll have cash value available to him. When he's 18, it won't be the whole 30 grand by the time he's 18, but, he'll have, 7,500 some odd dollars there. Now, thinking of it, with what I'm paying, I'm not paying per year what I would pay per month for this. So that's different. But if I was paying per month $120 in the life insurance policy, it would likely beat what I could do in a Coverdale. Or if you're thinking, in a great way, you can do both, right? So you do the Coverdale and you save this is what the wealthy do, right? So you save in a Coverdale, and then you also put that same $120 in a life policy. People, well, I don't know about putting that kind of money away for a kid. I used to hear that when I sold mattresses. I don't know about spending that kind of money on a mattress. I don't know about spending that money. I used to sell expensive mattresses at Macy's on Herald Square on the 9th floor. Miracle on 34th Street, Macy's. On the 9th floor is where all of if you've never been to 34th Street Macy's, or, Macy's of Herald Square, that's, Fashion Ave, all that good stuff. When the celebrities come to the store, they come to the 9th floor because that's where furnitures and mattresses are. And furniture and mattresses and Macy's are expensive as shit, right? We start at like $700 for a mattress, which really isn't expensive. And, they can go all the way up to 20 grand, right? And so, people would come in with, they'd go downstairs and they'd blow $5 grand on a Louis Vuitton bag, and then they'd come upstairs and be like, I'm gonna get this here Sealy Posturepedic for $800. And I'm like, you sleep on this? Are you serious? So it's the same thing. Make sure, you spend way more time in that bed than in that Benz. Think about that. Because you spent all that money to get them Lux seats, the massage comfort. I gotta be comfy while I'm on the road. I understand. Trust me, I do. Because I'm going to do the same thing. Right? Tax time is coming up. I'm going to ball till I fall. I'm going to go buy me a used 2000 Lexus with 400,000 miles. Right? And a We Are the World sticker on the back. But at the end of the day, there's always ways that you can diversify, right? So as you're diversifying, I'm going to have to go get me some more water. But yeah, Malika, so your question here. So if one child does not use all the money, they can transfer it to another sibling. Yes, and again, in cases where there aren't a sibling, you can change it there. She says, you're right, when their backs are hurting, they think about that good mattress. That's true, but it's the same thing here. So when you're spending that money on a child, realize that you're spending for their future, right? People would say, well, I'm not going to spend that kind of money on a kid. Well, you wonder why your kid is restless all day and falling asleep at school and acting out because they're not getting a good night's sleep. I ain't going to spend no good money on a kid to be on the bed. They're going to grow right out of it. Well, you sleep on a twin size mattress and you're, 56. So if it's good enough for the goose, it should be good enough for the gander. So we're going to be done looking at the Coverdale, and we're going to take a look at the 529. Because these are both, again, collegiate savings accounts. And we want to look at some of the differences, right? So bear with me 1 second there. I didn't pull up that account, did I? Yeah. Share. Okay. So this is the 529 savings calculator. So what are the advantages of a 529 college savings plans? Again, tax deferral can have a dramatic effect on the growth of an investment. With a state-sponsored 529 college savings plans, your contributions can grow tax deferred. Again, ladies and gentlemen, again, I implore you. And this says it here, a state-sponsored 529 college savings plan. Why do we say that? Because you can come to an advisor like myself and pay for a 529 savings plan. But most advisors will tell you for that particular product to get one from your state. It will save you on fees, not just fees from me, but fees from the company. You're also going to face fees from, state and federal taxes, so on and so forth. But it's a lot easier and better for you. And these are going to be licensed individuals from your state as well, who are advisors like myself, who get hooked up with the state and get compensated that way in order to provide you with the 529 plans. And these things are very state specific. They vary state to state very differently, even though they kind of work, similar. So it's best to go get one from your state. The fees will be lower. It'll be in your best interest. Again, this is specifically for a Section 529. That's not to say not to go get advice about a 529 before you go get one. But when you actually provide the funds for it, you can do it for free with your state. So let me just check the comments here. Okay. So there is no limit. Okay, sorry. So some states allow contributions to be partially or completely tax deductible and distributed income tax free as long as distributions are used for qualified education expenses such as tuition, fees, room and board in higher education institutions. So remember, just like I showed you with the Coverdale, where you had $67,000 with a taxable account, but with the tax deferred Coverdale or the college savings plan, you can actually have $80,000. $80,000 is a year's worth of tuition. If you use it for college tuition, that's completely tax-free. So you can pay $80,000 to your kids' college for free, tax-free, and build that money tax-free. So there is no limit on contributions, but some states tend to limit contributions once the plan assets have reached a defined maximum, typically between $230,000 and $500,000. Under a special election, you may make contributions of up to $75,000 per beneficiary in a single year without triggering a federal gift tax by accelerating 5 years worth of contribution gifts as of 2021. Married couples may contribute $150,000 per beneficiary in a single year. So now the assets are professionally managed by fund managers selected by the state. Like I said, they're going to have someone like myself who's selected, and we're going to, manage that fund for you. Again, not tooting my own horn, but, it's that all-star advisor. And before I continue, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, to purchase life insurance directly up to $1 million with an instant decision and no medical exam, or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description. As we proceed to give you what you need. She said, "Tutu." Well, thank you, Malika. I think that's you tooting the horn for me. I think that's even better than me doing it for myself when people that I've interacted with toot the horn for me. I appreciate it. And make sure that y'all go follow Malika on her Instagram. Malika, make sure you put your Instagram account in there because I want people to make sure that they see the craftsmanship and the work that you do. Worry not, my lady. I will be ordering from you, and I'm going to get the word out there because, like I said, that Black Panther, that Sonic, like you said, that Kobe Bryant, and Friday, we're going to talk about all of that. I want you to have some questions. One of the questions would be in regardless of anything, how what is a way to network with other people who may need my services, or maybe I need theirs. Maybe there's somebody who, provides the paper for you at a lower price. But again, so the assets are professionally managed by fund managers selected by the state. Participants can choose from 2 to almost 30 mutual fund type investments. Control of the account remains with the contributor regardless of the age of the beneficiary. A $75,000 gift is viewed as an accelerated gift over 5 years. Any other gifts to the same beneficiary by the contributor within 5 years may result in a federal gift tax liability. If the contributor dies within the 5-year period, a prorated portion of the contribution may be included in his or her taxable estate for federal estate tax purposes. So, we'll talk about the initial amount, the annual savings amount, the number of years the contributions are made, and then the assumptions. Okay? So, let's say $30,000, since that's what I said for my godson. So you had 30 bands sitting around and you put it up for your godson. You had 30 bands in a life insurance policy that was cash value that you bought when you were 23 and were like, nah, I ain't worried about nothing. I don't have no wife and kids. I have no need to get life insurance. But, you thought about it. You talked to someone like me. I talked to you about alternative concepts and reasons you might need life insurance. So you got a cash value policy and you overfunded it. And 15 years later, you had $30,000 of cash value available for you to withdraw from the policy. And you happen to have a son. And now, Reggie Jr., you want to start him a college savings plan. Not a life insurance policy, but a college savings plan. Well, you're going to have the funds there to fund it. So you fund it with some of that cash value from that life insurance policy. So you take 30 bands out, and then you're going to put, let's be honest, you're not, a bazillionaire. So you're going to put $5,000 away, $300 a month, a year. So that's $5,000 you're going to put away, right? Or $600 a month, I'm sorry. And so you're going to do that for 18 years, right? So that's right when he's born. You're going to say you're before tax bracket. Again, these are the historic rates. And we're going to say you're at a 25% marginal tax bracket. And we're going to submit. Let me check the chat here. Calculated moves, what's going on? She says, all right, I will post it. Yes, put it in there, Malika. We got to get you out there. So it appears that by saving in a Section 529 college savings plan, you would accumulate $322,112 or $271,584 after taxes upon withdrawal, meaning that you used it for purposes other than school, versus $249,430 in a taxable savings account. So if you save it in a 529, starting with that 30 grand, right? And you put the 5 grand away a year, with the interest you're going to earn 37.10 the first year, right? Whereas with the 529, 37.8. 44.6 the first year, 46.4 the second year, right? So then you look at year 18, you've saved less than $250 in the taxable account, where you save $322 in the non-taxable account, right? Because it's tax deferred, because you're not going to pay taxes on that if your kid uses it for college purposes. This is about 1 year at Yale, $322,000, by the way. So if you look at the calculations of the table down here, again, you're saving into it $5,000 a year. So your beginning balance is $3 grand, but you're saving also $5,000. So your very first year, you put 35 grand in. So your interest at 2%, at 8% is $2,800, but you're going to get taxed $700 on that. So your ending balance is $37,100, right? Whereas in the 529, you're going to put in $35,000. You're going to gain interest at 8%, which is the $2,800, and at the end, your balance is $37,800. Right? Not too much difference in year 1, but again, here as you see, year 2, it becomes almost a $5,000 difference. Year 3, it's again nearly $5,000. Year 4, it's above $5,000, and then it just grows in compounds, right? Because here it's what $298 is your beginning balance. I'm sorry, no, okay, I lost the number here. So your ending balance here is $249, whereas your $75,000 above in that scenario. So, these kind of products are very good for you. At any rate, ladies and gentlemen, I'm getting ready to hop off here. I've been on for nearly 2 hours. I go live at random for different purposes. It is what it is. We will get to it, and make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you can be made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, to purchase life insurance directly up to $1 million with an instant decision and no medical exam, or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description. And the question is, can people have multiple college savings plans at a time? So that's a good question. I'm wondering, so you're saying, can like a child have multiple plans from multiple people? Yes. But like you couldn't just buy, yeah, you can have as many college savings plans as can be afforded because it's from different persons, right? So but for the most part, they tell you to just contribute to the one. And then you can just contribute up to the state maximum, right? Because for the most part, you're not putting, $230,000 a year into a college savings plan yourself if you're a single parent. Shit, you're not putting $230,000 a year into a college savings plan if you're a married couple, especially if you're not making $230,000 a year, right? So with that, it's feasible, but it's more likely that you would just contribute to that college savings plan on their behalf, right? So like you may start it and then their parents can also contribute to the same college savings plan, right? So, for example, with my godson, you know, I may turn around and start a college savings plan for him, right? And then his parents may say, we want to do that. Or maybe, let's say like this, they already got a college savings plan for him. And outside of the life policy that I got for him, I want to contribute to his college because he's my godson. All right, cool. So in order to do that, let's go ahead and contribute $5,000 to what you guys are already contributing to his college savings plan, because you guys aren't millionaires, so it's not like you guys are contributing the whole 230. Shit, your house ain't even 230 grand. So I know you're not contributing that to his college savings plan. Not a diss, but it's the reality of the situation, right? I like to speak on truth and real facts. I like the drama too, but and don't worry, Malika, I'm gonna stick around for a little bit longer because I'm having fun. So it says, "Oh dang, I didn't seem that long. Get ready for your football tomorrow." Oh well, listen, the game is later on in the evening, which is one cool thing, and if anything, it's my wife who's doing more of the getting ready. She's doing more of the cooking and everything because since we moved out of our house, I had to sell my grill. So I don't have my grill anymore. So I'm not out grilling and stuff because normally you see me out grilling in the summer. And me and my brother, we have this little competition going on where we try to outdo each other. So like we'll go and buy things and grill stuff. Like he went. This guy now, he got into duck, right? Because we was into grilling, and he was like, "Oh, I'm the best griller," and I was like, "No, I'm the best griller," showing off our machismo or what have you. And so he went to go to the grocery store and bought some duck to grill because I was grilling ribeye and stuff, right? So but it's fun stuff to say the least. She says, "LOL, I get you. Just wondering if it was the same as with insurance plans." I'm not 1,000% sure what you mean in terms of with insurance plans. I mean, the way with insurance plans, like I said, I would always do both. For my godson, like I said, I did the insurance plan because most of the time we don't have the liquidity to be funding college savings plans properly, right? You notice I started it with 30,000, right? So that's 30,000 liquid, right? But that's 30,000 liquid, right? Here we go. Remember, we're starting that with 30,000 liquid, and then another $5,000 in that first year, right? So most of the times, especially in the Black community, we ain't got no $35,000 to be putting up front on a college savings plan, right? So if you make things like calculated moves, you can at 20 know that, hey, I should plan for the future. I know I'm going to want to have an investment vehicle for my kids, but I know in order to have an investment vehicle, I'm going to have liquidity. Even though I'm investing in Bitcoin and it might get there, even though I'm investing in real estate, and by the time my kid is born, it might be expensive real estate. It might be in a bad neighborhood by that time, right? For example, East New York, Brooklyn. Well, the properties, I was going to go buy a house for $800,000 in that neighborhood. It might have gone up in value. It might have gone down. Now, right now, it's appreciating in value. But I know East New York. And East New York, Brooklyn has not really gentrified well, right? In terms of the people who are over there. Like, you still have, things like the Pink House projects, right? Where I used to hang out. And you kind of got to know somebody to hang out in the Pink Houses, right? But, shoot, New Lots Ave, listen, that whole area is It may appreciate, but it may not. So you put something away in life insurance and say, okay, I know I have these dating and mating problems and I got to follow Kevin Samuels. And while Kevin Samuels is telling me I need to be papered up, this would be a good way to be papered up. I should take Kevin Samuels' advice. Get this life insurance and plan for the future, because he's always telling women, well, are you going to have $2 million by the time you die? Well, life insurance is a way to do that. Right? It's a way to save up for all that stuff that he's talking about. And see, worker, what's up now? Don't make me get messy, Malika. Hold on, y'all. I'm going to go grab me another quick swig of water, because staying hydrated is very, very important. And I'm using my new water dispenser, so I'm spoiled now. All right, I have returned. So again, ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Don't worry, we're going to get there, Malika. I need 2 million too. Yeah, these bots are all over the place. But, I feel like this. When they're all over the place, sometimes it's a good thing. There's spiders too. So to pick up content that you're speaking about, like this one says life. Well, I'm talking about life insurance. So hopefully it'll bring me to some algorithm out there. Right? And they're all Russian bots, if you notice that. It's always like Vivica, Veronica, Raptomomov. So I don't worry about those too much, because I'm not talking anything crazy. Right? Basically, they're probably here because of the music that I play. And so I get a lot of copyright claims, but it is what it is. So they're probably here because I played the Meek Mill song. See, people don't even think about that. For example, when you mention celebrities, think about it. When you mention stuff around your cell phone and then you pick up your cell phone and look at YouTube and see a Google ad, what pops up? Hey, I was just talking about Planet Fitness with my best friend. Why is it popping up on my cell phone? So again, though, having that lump sum of that 30K is something that you would have to plan for in advance. So like Kevin Samuels be saying, plan to be papered up, right? So in planning to be papered up, one of those things that you should be doing is, okay, well, let me put this life insurance on myself so I have some cash there. And it's going to show you where you'll have the cash. So, okay, I'm 20 now. In 18 years, I'll be 38. That's when I want to start having kids. I'll be almost 40. Oh, well, if I put $150 a month away in a life insurance policy now, by the time I'm 40, I have $56,000 available to me. I can either use that as a down payment on a house for myself. I can use that as take some cash out and go on a vacation if I'm still single and that's how I want to live. I can use that and I could take 30,000 of the 56,000 out and go, and pay for a wedding ring and a wedding. I can take 30,000 of that out if I'm having a baby and I'm not married, but I'm having a baby and I want to have a college savings plan for him. Well, I got $30,000 liquid that I can start this with. Otherwise, it's very difficult to start this with, $5,000 if you ain't got $5,000 up front. But with it being tax season, let's see. People aren't getting large tax returns. I know people who are getting $12,000, $15,000 back, right? So let's say you put $5,000. No, let's be realistic. $7,800 in that college savings plan. And every year, you're going to save $2,000 because, that's more realistic, right? You got your tax return, and now with your tax return, you're going to put, so your phone is spying on you. Yeah, ain't that the truth? So you got your tax return, you put, you paid off some bills, whatever, and instead of just putting this in the bank and letting it sit there because it feels good, you put it in a college savings plan for your kid. Throughout the year, you're going to put $2,000 away. Right? Let's make that more realistic. Let's make it $2,400. So you're gonna put $200. Yeah, no, we'll leave it at $2,000. Right? For 18 years. Everything else is the same. So it appears that in a 529, with those numbers, you'd save $112 versus 87,000 if you put it in the 529 versus just putting in the bank account for your kid. Right? So your taxable account, it would be $10,000 the first year, $10,500 the first year with the 529. But again, at year 18, when you're going to use it, right? Because this is, he's born, and now I'm going to use, this year I'm going to use my tax return. I was going to buy a Lexus, but my kid is being born, so instead of buying a Lexus, that's my kid's college. I'm gonna start with $7,800. I would pay $2,000 a year at least on car insurance, right? I'm assuming nobody I know pays less than $50 a month for car insurance, right? So $50 a month times what? 12 is what is that? $600. Okay. I don't know anybody that pays $50 a month for car insurance, to be honest. But if you do, that's $600 a year. And still, you could, even if that's all you save in your kid's college savings plan, being a responsible dude, that's a good idea. I think I'm going to do another video on that of ways to fund gifts. I'll do a pre-recorded on that. Well, Malika, that's people, they got 4 and 5 kids and, all that. You get a lot of money for kids. I know somebody who be selling their kids because they have more than 3 kids, right? And the max is 3 kids. So you claim them 3 kids and then boom. So then they be selling their kids to other folks. Oh, yeah, you can use my kid. Just give me, give me $1,000 off of them. Okay. And then they give their kid, here the name, social security, yeah, da. Boom, they put them on. Boom, they get $5,000 on their tax return. They give them $1,000. They up $4,000 just because they have a kid on their taxes. Yeah, it's sad, but it's true. I think I'll do a video about it. But so in a situation like this, planning for the future, your calculations there, you're going to compound it much larger with a 529. Or, again, let's say you don't have that initial $7,800, which again, in the first year is going to be $98,000 because you're going to put $2,000 in there yourself. Again, this is over the course of 12 calendar months. So you don't have to put the whole $2,000 in there up front when you put the initial $7,800. But let's say you put 0 in there, because most people are going to start, maybe they're going to put $2,000 a year away, just like with a Coverdale. Okay? So, based on that, if it's taxed, you're basically break even, but you're going to have almost $5,000 more in the Section 529. But you'll be able to spend that 69 as 80,000 if you use it for qualified school uses, right? So that's things like tuitions, fees, room and board, and higher education institutions. Okay? So you can also use these for K through 12, but you would fund them differently. Again, maybe you just start one because hey, my brother's girlfriend is pregnant. I'm gonna start a 529 for my new nephew or niece. Boom. And then they're born, and now you fund it fully, right? You put just a whole $100,000 in there, and then they hit kindergarten. You can actually use the 529 for them to go to a private, prestigious kindergarten in Beverly Hills, or what have you. Okay, so I'd be too kid to claim somebody else's child. You'd be surprised. Oh yeah, people get audited. They get caught for that shit all the time. Don't get me wrong, right? They get caught for that shit all the time. That's one of the easiest things people get caught for. But what happens is they let you compile it, because what people stupidly do is they shift kids around, right? So when you selling your kids off, right, you don't remember who you sold your kid to last year. And who you sold your kid to don't remember which kid you sold to them. So they either got to claim them again the next year, or you end up in sticky situations getting audited, because they put the kid on another one, and then they put the kid on another one, and then they finally put it on theirs, and then you got 5-6 years of them selling their kid off to different people, and boom, they're like, oh, well, now all you 5 people, because this social security number is associated with ABCXYZ. So it gets swifty. Don't get me wrong. It gets swifty. At any rate, ladies and gentlemen, I've been on for 2 hours. I'm going to come back later on and do some more. Right now, I'm going to go scroll these YouTube streaks, see what other folks are talking about. Have a good time doing that. So, I hope you guys enjoyed it. Make sure to support. Hit that Cash App. Ladies and gentlemen, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, to purchase life insurance directly up to $1 million with an instant decision and no medical exam, or to schedule a one-on-one appointment with a licensed financial professional, the link are in the description. With that being said, ladies and gentlemen, wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute. Huh? In Birkin bag, low. Devil Mercedes. Whoa. Boom.